Hi all, welcome to this tutorial. In this tutorial, we are going to do a comprehensive financial modeling which will prepare the financial statement for the next 5 years based on some assumptions. So this exercise definitely will help you to understand the different financial statement, especially the income statement, balance sheet and the statement of cash flow, and also the relationship between these three financial statements. So where these three statements are interlinked and how these statements are connected to each other. So through this exercise, you can definitely have an understanding how these three statements are connected. So to do this exercise, we will start with a case. So let's start with the case. So this is the case I developed for this exercise today. Three financial statements are written. So let's start with the case. Evergreen Packaging Limited manufactures eco-friendly packaging product. The company's management wants to project the company's financial statement for the next 5 years to support the expansion decision. So you already provided the income statement for the year 0, that is for the base year. You can see the income statement, revenue, cost of goods sold, gross profit, other expenses, EBIT, interest expenses, EBT, tax, and net income. So this is the income statement for the base year. So when it's come to balance sheet, the same, you can see the same thing: cash, assets saved, cash, account receivable, inventory, and property, plant, and equipment. Let's come to liability and equity: current liabilities, long-term debt, shares capital, retained earnings, total liabilities, and equity. So these base year balance sheet also given. So let's come to the cash flow statement, which is starting from for the base year. Here it is prepared through indirect methods. That means with the net income, depreciation is adjusted, and the changes in the working capital, it is adjusted. Cash flow from operations. So once after the adjustment, cash flow from the operation, then the capex expenses, debt repayment, then the dividend paid, and the net increase in cash and the NT cash balance. So one thing you can notice is that this cash balance in the balance sheet is always matching with the NT cash balance in the cash flow statement. So there are some assumptions given. That is the revenue growth projected 10% per year. Cost of goods sold is 6%, 60% of revenue, and gross margin is 40% of revenue. And the selling and admin expenses 15% of revenue. Depreciation, it is slightly use capex scheduled and our capex lifetime 10 years. Total yearly interest expense 60,000. The capex for the year month, there is 1 million worth of capex, capital expenditure. Then the working capital, AR is 12% of revenue. Inventory 88% of revenue, and the cash target minimum 150,000. Then the liabilities and equity. Current liability is 10% of revenue. Long-term debt 1 million. And the dividend 25%. And the share capital constant 1.5 million. Then the tax rate also given. That is 30%. So to start this financial modeling, first we have to prepare or we have to convert this data into an Excel sheet, which is given the income statement, balance sheet, and cash flow statement for the year 1 or base year. So I will open an Excel file here. I'm saving this Excel file named as 5-year financial statements. I'm saving like this. So in the Excel, so I have already a tab is there. I will convert this as my profit and loss account, P&L, profit and loss. Then the next tab will be my balance sheet. The next tab will be my cash posted. So what I'm going to do here, I'm just copying this income statement value from here and paste into my income statement. and just adjusting. So this will be my year 0, year, then I put year 1. The GP, I will add a space here after the GP. Then the EBIT. So now I'm just going to put my formulas are here. So in the cost of goods sold is 60% of revenue. So here I'm going to put the same formula into 60%. And the gross profit is revenue minus cost also. So here what I'm doing, and I'm going to apply this formula for throughout the year, throughout the period up to year 5. Then my next assumption, selling and admin expense 15% of revenue. So I'm going to apply the same here. It is into 15%. And apply it throughout the period. Then the depreciation we have to consider new capex. For now, I'm leaving the depreciation. Then coming to EBIT. Here it is my gross profit minus selling and administration expenses plus depreciation. So this is my EBIT. This also on applying up to year 5. So let's come to interest expenses. You can see the interest expense is 60,000. It is equal up to year 5. And the EBIT, my EBIT minus my interest expense, this is my EBIT. I'm playing this throughout the year. Then the tax expenses is 30%. Is also I'm applying up to year 5. Then the net income. Net income, it is EBIT minus tax expenses. This also I'm applying up to year 5. So this is, I just formulated Roctalo upon for the year 1, 2, 3, 4, 5. And here what now we are missing, it is revenue. Assumption already given, it is 10% per year. That is the revenue growth we are expecting. So I can put the same here into 1.1 is my revenue assumption. So I have applied all the formulas for the profit and loss account. Now what is pending, it is only the depreciation. So now let's move into balance sheet. Balance sheet also, I'm just copying from here. Now from the question, this from for base year. So this is the balance sheet I formatted for the base year. I'm just putting a formula here to see whether the total asset is always matching with the total liabilities and equity. So you can see that in the base year it is now matching with the total asset and with the total liabilities and equity. So now let's come to the balance sheet assumptions. The first assumption, first on the account receivable, 12% of revenue. So let's come to account receivable, it is 12% of revenue. So I am putting the equal here and coming to my income statement and into 12% sheet. So I'm just tracking this up to year 5. Then the inventory rate is 8% of revenue. Then there is a capex, it is already mentioning the year 1. So let's keep it now, we will do it. Now the cash target, it is minimum 150,000. It is the minimum balance target. Then let's come to current liabilities, it is 10% of revenue. This 10% of revenue. I'm just connecting with the income statement. Then there is a long-term debt is repayable evenly over 5 years. So that means there is a long-term debt is mentioned here, but it is over the 5 years this will be 0. So we can assume that 200,000 it is paying monthly. So for the year 1 it will be 800,000 and 600, 400, 200 and 0. So in the year 5 the total that will be 0. So then let's come to share capital. It is constant 1.5 million throughout the year. When applying the share capital here, it is throughout the year. Then the retained earnings. So retained earnings, what it is nobody, it is the previous retained earnings plus current year profit. That will be the retained earnings BATs. So I'm applying this. So that will automatically pull out the data from the income statement. Then what we have can do with is the cash and property, plant and equipment. The cash we are just leaving now to, it has to be connected with the cash flow statement. Let's look into property, plant and equipment. PP we have one new properties there, that is 1 million. So for the PPE I'm doing a separate table here. This is of my offering balance. Here it is 1 million, it is there. Then the year, this is the operating balance in year 0, and the year 1 there is additional 1 million. So this is the addition. So the PPD balance before depreciation, it is this one here, this one the balance, get the balance plus what is adding this year. So this is the balance without the depreciation. And now let's come to depreciation. Depreciation it's mentioned, it is 10 years or capex lifetime is 10 years. So 10 year mean it is, we can just divide it by 2. So the depreciation value is divided by that. So this will be our depreciation value for the throughout the month, throughout the year. Then the PP, property, plant and equipment value after the depreciation net EP. Here it is already given 1 million. For the year 2, this will be operating balance plus added minus the depreciation value 180,000, and it is 1.6 million in year 2, 1.4 million in 1.8 million in year 1, 1.6 million in year 2, 1.4 million in year 3, 1.2 in year 4, 1 million in year 5. And just apply. Now we got the value. So I'm just connecting this with the balance sheet. 1.8 million in tier 1. I'm just connecting this one. Okay. Then the next thing, the depreciation also we calculated for depreciation as to reflected in the income statement as well. So here we can calculate the depreciation as well. For the year 1 is already given. Now for the year 2, it is 200,000 throughout the. So now we completed the income statement, profit and loss account and the balance sheet. Now we are moving to cash flow statement. So in the, here is again there is a review pending here. Definitely in the cash balance we have to add from the cash flow statement. And then let's come to cash flow statement. So I just formatted this into the same format what we designed for the other two income statement, other two statement. Now what I'm doing, Here the net income I'm connecting with the income statement. So it is already in the income statement and is connected, and I applied this throughout the year. That means up to year 5. Throughout the period, that is up to year 5. And the depreciation also already given in the income statement. So I'm connecting this with the income statement. And the changes in the working capital. Changes in the working capital, it is the changes in the account receivable, inventory, and the account payable. So we have to mention all these separately. So in the year base year, it is already mentioned at 0. So we will put like this: the changes in receivable, account receivable, changes in inventory, and changes in account payable. We are going to put like this. In the year base year or year 0 is already mentioned are as 0. So now we're going to put the formula for year 1. So I'm put equal. Just coming to balance sheet. Here we are looking the first one, the account receivable. So you can see that the account receivable from year 0 base year to year 1, the account receivable has increased. Account receivable increase which has a negative impact in the cash flow statement. So it is this minus this. So I'm going to apply this throughout the period up to year 5. Then the changes in the inventory. Again, I'm coming to balance sheet. Just looking to inventory. You see the inventories are increased. Again, the same impact, it is a negative impact in the cash flow statement. So I'm putting the same formula here and applying throughout the period. Then the changes in the account payable. Just looking to account payable, that is current liabilities. You can see there is a increase in the account payable or current liabilities throughout the year. So it have a positive impact. So I'm doing the formula year 1 minus year base year. So it's come as a positive impact in the cash flow statement. So now the cash flow from the operations. So I'm putting the sum here from here to here. So again I'm applying this throughout the period. Again my capex spending, it is already mentioned a capex spending here in the year 1. There is a capex spending of 1 million. So I'm putting the same spending to here. After there is no spending, so I'm just dragging that formula, so nothing coming there because there is no spending. Then the debt repayment. Again, the debt, long-term debt, it is 1 million. 1 million. Again, it is repayable eventually year 5. So we already mentioned that it is. You can see if you look into the long-term debt, 200 is reducing every year. So that 200 we have to consider here as a cash outflow. So I'm doing as. Then the dividend payment, it is 25% of net income. So that is the dividend payment. So here I'm putting the formula here. So here my formula. From the year 1, I'm taking the net income into 25%. Here it is coming as a positive number because it's a cash outflow, so it should be a negative number. So I'm just multiplying with minus 1. So this is my dividend payment. So then now let's compute increase in the cash. That is cash flow from operation plus capex. Again, one more thing, the capex payment, this is a payment, so it should be a negative number. So I'm multiplying with the minus 1. Then the debt repayment also a negative number. I'm multiplying it with the minus 1 to get the negative number. Apply throughout the year. Then the net is the cash. So it is the cash flow from operations plus capex plus debt payment plus dividend payment. So this will be my net increase in the cash. Then let's come to ending cash balance. And so ending cash balance, it will be previous ending cash balance plus net changes in the cash. So this will be my ending cash balance. So this I am applying throughout the year. So with the same cash balance, I have to apply the balance sheet as well. So in the year 1, I'm taking from here. Here is the retail earnings. We did a mistake previously. We took the complete profit as retained earnings, but it is already mentioned that 25% is paying as dividend. So it is only the 75%. So I'm just changing the formula here. The previous retained earnings plus I'm going to income statement, net income into 75%. So this formula I put it inside a bracket. So as a final outlook, I'm just formatting this here, applying the same character to hold. So now it is over. We have prepared the profit and loss account, balance sheet, and cash flow statement from based on a case. So here what we did actually is the base year statement is already given. So we set the base year statement as a basic or foundation, and we will build the case for the year 1, year 2, year 3, year 4, and year 5 based on the given scenario. So it is very important to match the total asset with the total liabilities and equity. That is the basic accounting equation. So again, while you're doing this financial modeling, definitely you will understand the structure, how it is structured, the income statement, balance sheet, cash flow statement, and how these three statements are interlinked and connected. So this is very important to understand how these statements are interlinked and connected to have a deep understanding and deep analysis skills while we are doing the financial modeling. So this is about today discussion, today video. Again, I'm attaching this case for your reference. So please try to do the same exercise yourselves. So you'll be very familiar with the three financial statements, that is income statement, profit and loss account, income statement, balance sheet, and cash flow statement. Thank you for watching this video.